Good afternoon, and thank you for joining us for today's webinar, New Changes to the Tax Law, presented by PB Mayers, a top 100 CPA and business consulting firm, as noted by Accounting Today and Inside Public Accounting. My name is Andrea Sardone, and I will be facilitating our webinar today. Today's webcast is being recorded, and you will receive a link to it along with the slides in our follow-up email to you after this broadcast. Before we get started, there are a few housekeeping items to discover. If you have any questions during today's presentation, you may enter them into the questions box on your screen, and we will attempt to answer as many as we can during this webinar. If we do not get to your question, a member of our team will follow up with you after this webcast. We thank you in advance for your patience. You may experience technical difficulties during this live webcast. We are recording today's presentation, and you will receive a link to the recording free of technical glitches. Today's webinar will guide you through the significant tax law changes resulting from the passage of the Inflation Reduction Act, which was signed into law on August the 16th. Our panel today is composed of members of PB Mayers' Emerging Tax Issues Group. Kevin, Ed, Miriam, and Ryan have analyzed the legislation to provide you with actionable insights for you and your organizations. You can find their bios in the handout section of your screen. So let's get started. Kevin, are you ready?
Yes, Andrea.
So while we're waiting for those slides, Kevin, do you want to maybe start just maybe a little bit of the background of how we got here?
Sure. I think if we're looking at this, and we've got the Inflation Reduction Act of 2022, but that is just 1/3 of the plan that the Democrats came in with at the beginning of the term when the President Biden and the Senate and the House were there. This is really 1/3 of the bill. They had a COVID relief legislation, which was passed on a Democratic only vote. We had the infrastructure bill, which was bipartisan, and pretty much everybody thought that this was going to be it as far as any type of bill that came out of the original plan. But there was a lot of people objecting to what was going on, to see what was happening. But finally, something did happen. And if we can get to the next slide. There we go. Okay. So it is a slimmed down version of the Build Back Better bill. And that's a mouthful. So Inflation Reduction Act's a lot easier to say if nothing else is going on. But Senator Manchin and Senator Sinema were objecting to it. And as we know in the Senate, that it's a 50-50 split. So you had to have all the support of the Democrats in order to get it passed. So they made some compromises. They went through. One of the slides we have near the end talks about what did not make it in, which I think is important because there's been so many rumors going on as to what happened and what didn't go on. But it did pass. It passed in August. It was signed into law on August 16th, right before Congress adjourned for its August recess. It is a smaller version, and it affects large corporations, stock buybacks, renewable energy incentives, and the one that probably has received the most negative press is increased IRS funding. So Ryan, if you want to just kind of start us off on going over a few other things.
Sure, thanks, Kevin. If we can go into the next slide. So we have really two main tax changes with the Inflation Reduction Act. The first of which is a alternative minimum tax, or an AMT tax. Now you may be more familiar with these with your individual taxes, but this one is focused on C corporations. It's going to be effective December 31st in 2022 or 2023 on your taxes, and it's going to introduce a 15% tax only for C corporations. Now there is a threshold level where this applies to, so it's only going to be corporations that have an average net income of $1 billion. So that's going to rule out many corporations but it is good to keep in mind where that threshold is, and it's an average of the current year and your prior 2-year net income. For companies that are foreign partnered multinational groups, that threshold is lower. It's $100 million. We'll go on the next slide and kind of see some more about this. So rather than affecting your corporate income taxable income, this is based on book income or your financial statement income. This is a lot different than our normal AMT, where now you can face a higher tax on your book income than maybe you had a taxable income on your tax return. This can be due to differences such as accelerated depreciation, tax to or accrual to cash changes, and just overall temporary differences. So really you want to understand that the AMT can affect a higher income level because of your book income rather than where your tax return income may be at a lower level. If you go on the next slide, we'll talk about our second tax change. This again is affecting corporations and effective December 31st, 2022, and this is an excise tax on corporate stock buybacks. It's important we emphasize this is only affecting publicly traded corporations or those that are traded on stock exchanges. It's going to be a 1% tax on the fair market value of the stock that's being repurchased. This also applies when corporate stock is repurchased by subsidiary companies that have a 50% or more ownership of their parent corporation. Unlike most excise taxes, this is not deductible on the corporate income tax return, so there's no offset. And I think we can go forward a slide. And we'll go forward one more and talk about some of the exceptions to this. There are 6 main exceptions. The first of which is this excise tax does not apply to is with reorganizations when there's no gain or loss by shareholders. This is typically common with mergers and acquisitions. The second is with retirement plans and employee stock ownership plans. Again, this excise tax will not apply. The third is probably the largest exception, and this is if the total value of the stock being repurchased is less than $1 million during the year, in which case you will not have to face this excise tax. Another is with investment companies such as regulated investment companies or real estate investment trust. Again, this will not apply. And then companies that are considered dealers in securities when they make repurchases. And then the final exception is when the repurchase is treated as a dividend for their shareholders. So overall, we have 2 significant tax changes that apply to corporations that are used to raise revenue for this bill, but there's a lot of corporations that this will not apply to based on the thresholds set by the bill. That's the excise tax and AMT tax. And with that, we'll pass it on to Miriam to talk about some of the next topic.
So the next changes that we're going to cover are on the individual side. So the first one is residential energy credits. Like Kevin mentioned, a lot of the changes are for renewable energy. This one in particular, it's for more efficient energy. So for a home, if you buy heat pumps, insulation, and doors, it's called the non-business energy property credit. For 2022, the credit amount will be 10% or 100% of the cost. It depends on what you're putting into service, and there is a lifetime limit of $500. So this was the credit that was available in 2021. You can look at it as retroactive or that it was extended, but that's the rate that's for 2022. For 2023, the credit is 30% of the cost, and the limit will be $1,200 annually. And the next credit, if we go to the next slide, is for solar panels that generate electricity and also other clean energy. So we're renaming the previous residential energy efficient property credit to residential clean energy. So it's, like I said, just including solar panels, wind energy, and the credit will be 30% for 2022 to 2032 and 26% for 2033. So there's a phase out. Previously it was phasing out, but they increased the number. And also an important point is for 2023, there's added eligibility for battery storage. So this means if you have solar energy that is being gathered and stored in a battery, those costs are also covered for the credit. And we have additional changes to credits, and which Ed Yoder will be explaining next.
So the Inflation Reduction Act also addressed electronic vehicles. They rebranded the EV credit to be now the Clean Vehicle Credit. Previously, the credit was based on a production quota and was limited when a manufacturer had produced 200,000 vehicles. So the Teslas, the General Motors, and now Toyota have all eclipsed that 200,000 unit limit. And they were actually not eligible for the electric vehicle credit going forward. So the Inflation Reduction Act made some modifications. Senator Manchin in particular wanted to see some other limitations on this credit. And so we'll talk about some of those that made it into the bill. Now there's going to be requirements that the vehicle have critical materials and battery components that are produced in North America. So these requirements would render electric vehicles made by foreign entities of concern ineligible. And when we read foreign entities of concern, you can insert China. Essentially, Congress was making these electric vehicle credits so that Chinese manufacturers couldn't be eligible, as well as other foreign manufacturers. There's also an interesting requirement that the final assembly of the vehicle occurs in North America. And that component of the Inflation Reduction Act was made effective with the signing of the bill, with the enactment dated August 16th of 2022. So vehicles that would have otherwise qualified for the tax credit prior to August 16th, many no longer qualify because they didn't have final assembly in North America. I'm aware of the Volkswagen electric vehicles, Hyundai and Kia electric vehicles. Those are produced, manufactured and assembled overseas and then shipped to North America. So after August 16th, their vehicles no longer qualify for this tax credit. The Clean Vehicle Credit eliminates the limit on the number of credit eligible vehicles, but there is only one credit per vehicle. The bill imposes limits based on taxpayers' income. And what's also interesting here, the Clean Vehicle Credit will be transferable. So you'll be able to use the credit as a down payment or in exchange for payment from the dealer. The credit applies to periods after 2022 and goes for 10 years and terminates after 2032. Next slide. Here we see that the credit will be broken into two components. Half of the credit, $3,750, will be based on critical materials that are extracted or processed in the US or any country with which the US has a free trade agreement. And the percentage of critical materials increases, starting with a 40% percentage in 2023 and eventually gets to 80%. Then there's a component, a second component for the battery components, which will be half of the credit, $3,750, that are manufactured or assembled in North America. And those applicable percentages also increased so that after 2028, 100% of the battery components have to come from North America. Next slide. There was some criticism with the previous electric vehicle credit that taxpayers, only the wealthy, were really taking advantage of the electric vehicle credit. And so to put limits on that, there is an income threshold. So those married filing a joint return, their modified adjusted gross income cannot exceed $300,000. So they have to have modified adjusted gross incomes below 300,000. For head of household, it's 225,000. For single taxpayers, it's 150,000. There's also limits that are placed on the value of the vehicle at the time of sale. So if it's a van, SUV, or a truck, the sales price has to be at less than 80,000. And then all other vehicles, it has to be 55,000 or less. So these are really geared for what's expected to be common vehicles to be purchased in the near future. Next slide. The Inflation Reduction Act also created a new category of electric vehicle tax credits for previously owned vehicles. Qualifying previously owned clean vehicles that are purchased for taxpayers whose adjusted gross incomes do not exceed a specified amount. The credit will be the lesser of $4,000 or 30% of the sales price. Adjusted gross incomes for married filing joint returns have to be below $150,000. Head of household, it's $112,500, and single, it's $75,000. So we see that those modified gross income numbers are half of what the income limitations were for new vehicles. The model year has to be which is at least 2 years earlier than the calendar year which the taxpayer acquires the vehicle. That means it has to be at least a vehicle that's 2 years old, and the sales price has to be less than $25,000. So there could be a situation where someone buys a used clean electric vehicle that they still don't qualify because the sales price is over $25,000. And there's limitations upon how many credits a taxpayer can get. You can only get one of these used vehicle credits within a 3-year period of the sales date. Next slide. So we have a polling question here. If we can launch that poll, it's geared towards whether or not you think you might be able to take advantage of the new clean vehicle energy credits. Go ahead and select one. The answers here are yes, but I think my income is too high. Yes, but the model I'm interested in is not eligible. No, I'm going to keep buying gas. Or are you looking to buy a clean vehicle right away? Hopefully you've had a chance to answer that poll. I think we can close that and see what the results are. Yeah, it's still, people are still used to buying combustion engines, and that's still going to be the primary mode, I think, for most taxpayers. But that will be changing in the coming 10 years. So we will see this credit become more important to taxpayers in the future, I think. Getting back to our presentation, the next slide. The Inflation Reduction Act also addressed the premium tax credits. These are credits for purchasing health insurance on the open marketplace. These premium tax credits came out of the Affordable Care Act, the Health Care Act, also referred to as Obamacare. We've had the Affordable Care Act with us now for over 10 years, and several people, many taxpayers take advantage of these premium tax credits that were set to expire after 2022. There are most people that purchase health insurance on the marketplace are able to take advantage of these premium tax credits. Statistics show that 13 million out of 14.5 million households do get some kind of credit. And I would think that for many people that are purchasing health insurance on the marketplace, they're looking to get a subsidy for that health insurance purchase. There were restrictions previously that in order to get a premium tax credit, your taxable income, your modified adjusted gross income, had to be within 400% of the federal poverty level. But the American Rescue Plan Act of 2021 removed that limitation for 2021 and 2022. And now the Inflation Reduction Act extends the premium tax credits just for 3 years. For 2023, 24, and 25, there's still no cap, but premium costs are limited to 8.5% of income. So as your income scales up, you're going to get less credit. These credits, of course, can be received in advance or at the time that you've purchased the health insurance, as it reduces the premium you're actually paying. And then the tax return, the taxpayer files Form 8962 to reconcile the income with the credit received. And we have seen situations where taxpayers receive a credit because they tell the marketplace they're going to have a lower income, and at the end of the year their taxable income is up, and then we find out they don't qualify for as much in the way of premium tax credits, and they have to repay those credits that maybe they received in advance. Next slide. So we've given you quite a bit of the pillars, the tent poles of what were in the Inflation Reduction Act. There were a lot of things that didn't make it, that were originally part of the Build Back Better bill. Originally, I think the Build Back Better bill was expected to cost taxpayers somewhere between $3 and $5 trillion. The Inflation Reduction Act, as it was enacted, as Kevin noted, is about 1/3 of that in scope and cost. So the Inflation Reduction Act is expected to cost about $1 trillion. There were a lot of things included in the Build Back Better plan that did not make it. So the things on this slide did not happen. Originally, the Build Back Better bill was looking to increase corporate income tax rates from 21% to 28%. They were going to increase the highest individual marginal tax rate from 37% back to what it was, 39.6%. There was discussion to have a new surtax on high income individuals, those with taxable incomes over $1 million. This surtax was going to be somewhere between 5 and 8%. They hadn't decided. There was going to be an expansion of the net investment income tax, which is a 3.8% tax that helps fund the Affordable Care Act, the premium tax credits I just mentioned. The net investment income tax currently is a surtax that's applied to taxable incomes over $250,000, but only on their net investment income. The Build Back Better plan was going to expand that beyond net investment income to include active trade or business income. And we would have seen many taxpayers with pass-through businesses over $250,000 suddenly see their tax bill increase almost 4%. The Build Back Better plan was looking to increase the top capital gains tax rates from 20% to 25%, and they were also looking to repeal gain deferrals from like-kind exchanges. And currently, real estate transactions is really the only place where you can take advantage of gain deferral on like-kind exchanges. Next slide. So all of those were significant tax increases, and the reason they were trying to increase taxes that much was because of the benefits that they were trying to provide, particularly with increasing the child tax credit, increasing the amounts that were paid out to taxpayers, and then there was going to be a significant expansion of child care access. to make essentially childcare universal for all. And that's why there needed to be such large increases on the revenue side to cover those costs. But that did not happen. They've made no changes to Section 199A, which is the qualified business income deduction, the 20% deduction for certain business owners with pass-through income. That has remained intact. They did not make any changes to the $10,000 SALT state and local tax exemption amount, or the deduction that you claim on itemized deduction. That $10,000 cap remains. They did not make any changes to estate or gift tax exemptions. There were no changes to estates for inclusion of grantor trusts, no changes for the use of valuation discounts on transfer. There were no changes to the research and development credit or immediate expensing or expansion. So that somewhat limits R&D tax credit opportunities. And there was some talk about expanding the employee retention credits into the fourth quarter of 2021, but that did not happen. Also discussed with the Build Back Better bill was addressing the carried interest loophole. And this webinar really isn't set up to cover carried interest, but what you need to know is developers, people that develop real estate development in particular, would set up entities where they received an equity interest in the development and could essentially convert ordinary income into capital gain tax activity. So they could reduce their tax rate exposure through the carried interest loopholes. When President Trump was in office, he talked about wanting to address the carried interest loopholes, and the Democrats have continued discussing that, but nothing was changed with carried interest. And so again, these last two slides did not happen, but I think it's important to discuss that just to know what did happen in the bill. Our next slide, I think, is a polling question. Yeah. So if we could launch that poll. There's been a lot of discussion about the Build Back Better bill. Which tax proposals were you previously most concerned about that eventually did not get included in the Inflation Reduction Act? Expansion of the investment income tax to active businesses, changes to capital gains rates, increases to the individual or corporate income tax rates, or changes to estate and gift tax exemptions. And if we can close out that poll and see what the responses were. Yeah, changes to capital gains rates and step-up benefits was the most concerning, and of course those changes did not happen. Back to the slides. And Kevin's going to cover the budget needs of the IRS.
Thanks, Ed. And I think if we're looking at some of the things that did not make it into the bill, it is important to note that in a compromise, nobody's happy. So a lot of the Democrats did not like the fact that all of those items in red were not passed. They didn't like the fact that they couldn't have increased taxes. So that was why it was very difficult to get it passed, and it took such a long time, and why it was split into three as we're going through. The biggest thing we've heard about that everybody is talking about is the increase in funding for the IRS. If you're looking at this picture right here, that's a typical IRS government office. As you can see, there's a lot of computers. No, there's just paper. And if the Washington Post just did an article where they had a picture of the cafeteria of the Austin Service Center, which was completely covered with paper returns and paper from letters being sent in to get to fix problems. The IRS was sending out bills saying that you haven't responded to their questions, and you had responded to your questions, but they don't know where the response is. So I think when you're looking at some of these things, that's the issue they were trying to address. And if we can go to the next slide. So the current budget that had already passed said there was going to be $700 million more in 2021 fiscal year, which ends in September 30th. And it was a 6% increase. So the total amount was going to be $11.9 billion for the IRS. Now, that still doesn't equal what they received in their budget in 2010 when you adjusted it for inflation. So if you look at it, what are they going to do? Well, they have very few employees in comparison to what they had in 2010. They had 74,000 in 2019, right before COVID started. 2021, they did hire some 7,000 people, which is about 10%. And in 2010, they had 94,000 employees. Now that's 15% more employees in 2010 than they have in 2021. And one of the things we have to realize is that tax law hasn't gotten simpler since 2010. And you're looking at it, and there's more and more questions coming out. Taxpayers have more questions as they're going forward, and it's something that people are desperately looking to get some guidance and advice. You can go to the next slide, please. And one of the things that has been talked about is the playing the audit lottery. You're going out there and you're taking positions on tax returns with the expectation that the IRS is not going to come out and investigate you or check out your return. The corporate, for normal corporations, we're not talking about the large corporate, we'll get to in a second, but if you're looking at the information, in 2019, only 2.9% of corporations were examined. And that's the total universe of corporations. And that was still 100% increase since 2010. So in 2010, there was roughly 1.5% of the corporations examined. Many large corporations are examined every year. In their main headquarters, there's a separate audit, a separate office for the IRS auditor, who is in there pretty much year after year after year, and they'll just switch out who's doing the actual audit. So 98% of corporations in 2010, what they consider as large corporations, were examined. And in 2019, only 24% of those companies were examined. And that's where the big dollar amount comes in when you go in there. That's where you see all the court cases, because they're coming out and they're really addressing major issues. And that's where you have everybody complain about their book income being $100 million profit and their tax income being a loss. That's one of the things that Ryan covered as far as why they wanted this corporate this corporate alternative minimum tax. So there's very little activity by the Internal Revenue Service in examining these big companies. Individual audits, that's 0.25% of the returns of individuals were examined in 2019, and these are the last year that these numbers were available for when you're going through it. So that's 0.25%, and that's down 72% since 2010. So the odds on getting audited didn't seem to be all that great. And if you're looking at it, yeah, as you went up in income, you did get a bigger chance of being examined. or if you have a lot of complicated things. But it was 8.7% for returns with annual income over 10 million, 2% if annual income was between 5 and 10 million, and 1.3% if income was 1 to 5 million. Next slide, please. So in any case, there's not a whole lot of people being examined. And that really goes to the integrity of the tax system itself when you're looking at it. So what is the IRS funding occurring in this bill? Well, it is not to have all IRS agents armed with AK-47s or anything like that and come beating on your bill when you're going through there. It's to improve taxpayer service. If any of you have ever called the IRS or have asked our office to call the IRS, if you're going through and you're looking at that, you know, the wait time is 1 to 3 hours, and then they'll cancel you. So you've waited all that time on the phone, and then they do it. If you filed a paper return a while back and you're still waiting for your check from 2021, 2020 in some cases, this, you know, taxpayer service is going to help to get you that information. Yes, there is $45.6 billion for enforcement included in the bill, and Ryan covered some of the tax aspects of what was being raised in order to pay for this bill, and they are calling it the Inflation Reduction Act. So they're supposed to put some money towards reducing the corporate debt. But it's $45.6 billion for enforcement and $25.3 billion for operations support. And you know, I think as accountants, we like to see operations support. We like to see them have a computer program that actually works. They're going to spend $4.7 billion for business system modernization. And what's interesting about that is over the years, they've never had sufficient funds to modernize their system. So they still use lots of paper. They still use, while they're requiring electronic filing of most returns, they still get a ton of paper in and out of the service centers every day. What was also interesting is that there were 2 additional directives contained in the bill. And the first is that IRS must report to Congress on the cost to develop a free direct e-file system. So they're not developing a system. They have to figure out how much it would cost in order to develop the system. And I think that's the intent, is to get everybody to be able to e-file automatically on their own, as opposed to going through certain groups that have the ability to do that. The one that I think is the most interesting is that the increased IRS funding is not intended to raise taxes on taxpayers with taxable income below $400,000. Now, one of the things that has not been addressed in this, and I think all of us who are trying to hire employees can realize it, is that even if they are going after all these additional people, they want the support, where are they going to find them? And it's very difficult. We're pretty much at full employment. You know, it's bounced back since COVID, that if you want a job, you can find a job. But these would be technical people in a lot of cases. The enforcement agents are usually, have to have a college degree when you're going through it. So there's a lot to do with finding the proper people and seeing if you can do it. The other issue too is, as well, is it takes a while to train these people. And you're talking about increasing the IRS funding on taxpayers with taxable income below $400,000. Well, when you start off at the IRS, and you know, I started my career as a Yankee revenue agent in Texas, which made me very popular. I think if you looked at it, it's a 6-month process to train these people, and they're training on smaller returns. because until they get the tax law down and until they have all of this other stuff, they need to learn how to audit itself. So I don't know how the IRS is going to work on not touching people with taxable income below 400,000. But that's what the rule is. That's what the intent is that they're hiring these people to go after the higher income people as they go forward. So this $80 billion increase in IRS funding gets it only a little bit higher than what it was in 2010, adjusted for inflation. And it's supposed to net $124 billion over a 10-year period. So that means if it's 80 billion increase over 10 years and 124 billion in net revenue, we're talking about $200 billion over a 10-year period that is going to be brought in additional taxes. So it is a major issue. It is something that hopefully will make dealing with the Internal Revenue Service a little easier as you're going forward. But it is not an unreasonable change to what's going on, mainly because it only gets us back to 2010 year with adjusted for inflation. That's pretty much everything that's in the bill. If we can do the next slide. We've got the final polling question when you're going through there. And if we can put that up, please. And it says, are you worried the changes in the IRS budget and enforcement efforts will have an impact on you personally or your business? No. Should I be? No, the audit rate will remain low. Yes, because maybe I can get my refund sooner. Or yes, additional attention from the IRS is never a good idea. Let me take a couple of seconds to fill that out. Okay, and if we can close the poll. I like no should I be and no the audit rate will remain low. If you're looking at 63% of the people think that it's not going to have that much of an impact, and it shouldn't, and you can't tell that from the politics going around with the announcement of the message that's probably true. Most of the people in the United States, most of the individuals or corporations will not be impacted very much by the changes. Hopefully, they'll be benefited in a positive manner. So if we can go to the next slide. And we do have a couple of questions going in. Miriam, I think the first one's for you. Are the residential energy credits only for a primary residence?
So that's a great question. For energy efficiency improvements, yes, the component must be on the taxpayer's principal residence, and that's in the statute. For solar, it looks a little more open. It's saying a residence, except for fuel cell property. So it's worth it to look in the statute to check for that. Great question. And if for the solar energy, I feel like maybe the IRS will issue guidance. It had a notice out for the expenditures for home efficiency and solar under previous 25 CND. So I would say maybe we should look out for those. Thanks.
And Miriam, just to kind of follow up on that, what about something like one we've had from a lot of our clients, like rental property that they own through an LLC or something like that? Will any of these credits apply to those?
So that's a question that came up with our clients, like Kevin said. It looks like for solar energy through the general business credit, businesses can, invest in solar energy and look at that, but the efficiency property credit is not for businesses.
Okay, thank you. And Ed, the next two really are dealing with electric vehicles. When we're doing this, one, what EV companies will qualify, and secondly, will there be a list or something that shows where the vehicle is assembled and made so you can get the credit?
Yeah, there already is a list. The Department of Energy has a website for the Inflation Reduction Act where they list the electric vehicles that are assembled in North America in 2022. And then they also give a 2023 list. Because of changes in the electric vehicle tax credit, the final assembly piece has to be in place after August 16th of 2022. And then it's not until January 1 of 23 where the battery and material component requirements come into place. But I'll read some of the vehicles that are currently on this list. For 2022, Audi makes a Q5, BMW has a 330 and an X5, Chevrolet makes the Bolt EUV and the Bolt EV, Chrysler Pacifica has a plug-in HEV, Ford Escape, the Ford F-Series pickup truck, and the Ford Mustang Mach-E will qualify, along with the Ford Transit van. GMC is releasing the Hummer electric pickup and SUV that will qualify. Jeep Grand Cherokee plug-in hybrid and the Jeep Wrangler plug-in hybrid. Lincoln has an Aviator and a Corsair. Lucid Air is a new manufacturer. The Nissan makes the Leaf. We've seen a lot about Rivian, the new truck manufacturer. Its models will qualify. The Tesla Model 3, Model S, Model X, and Model Y qualify, and the Volvo S60. So all of those vehicles I just named have final assembly in North America, but they only will qualify for 2022. As we roll into 2023, there's currently 5 vehicles that will qualify. The BMW 330, the Bolt EV, the Cadillac Lyriq, which is a new SUV, the Mercedes EQS, and a Nissan Leaf. So yes, the Department of Energy has a list, and just be careful before you buy an electric vehicle.
And another question came in while you were going through the list. Will the clean energy car credit apply to hybrid vehicles and not just, hybrid / electric and not just electric?
Well, the clean vehicle tax credit will apply. There are credits for electric vehicles, so it has to be battery operated, or there will also be hydrogen credits out there. I do not believe that a hybrid will qualify.
Okay. Well, thank you. If anyone has any more questions, you can just follow up with your person who you deal with at PB Mears, and we'll be sure to get you the information that you need. But as you can see, other than the energy credits, most of the tax increases that are contained in the bill will not apply to many of you because of how they were trying to direct it solely to the very high income type of people. So with that, I think I'll send it back to Andrea.
Yeah, thank you, Kevin. And thank you, Ed, Miriam, Ryan, and Kevin. Very interesting information. And we will also post that list of the vehicles that qualify for the tax credit. So we'll definitely post that on our website and also send to you in a follow-up. So thank you for joining us today, and we do hope you found this presentation useful and informative. And as Kevin said, please do not hesitate to reach out for more information. If you have a question if you have a question later on today or tomorrow, please don't hesitate to send that to us. At the conclusion of today's webinar, you're going to receive a brief 3-question survey, and we ask that you take a few minutes to complete it. Your responses will help us develop future webinars. Again, this year, we will be counting down the top 10 tax strategies, you'll be receiving an invitation to this must-see event, which is scheduled for November. So please stay tuned for that. Thank you again and goodbye.